How do you know if a company is being honest in its reporting of earnings? Quality of Earnings by Thornton L will show you how to avoid being duped by companies employing creative accountancy. Number 1. Don't trust your analyst. If you place a lot of stock in what your analyst says and do not do your own due diligence when it comes to researching a company, you could end up investing in a company with bad long-term prospects. But surely you say, the analyst is going to know more than me. Perhaps, but Oglove points out there are institutional incentives to be positive about companies. He outlines some of the following points. 86% of brokerage houses' recommendations were either neutral or a buy. One reason is the analyst can form close relationships with executives and PR people within the firm, who pass on tips, hints, and other information to make the analyst's job easier. If the analyst doesn't fulfill his side of the bargain, these relationships go sour. Also, if the investment banking part of the firm the analyst is working in is currently worrying the company in question, pressure on the analyst to provide a positive review can be intense. The last reason is that human instinct to go with the crowd. That is, even if you're wrong, and everyone else is too, it takes the pressure off. Those that go against the crowd and are wrong have to be willing to look the fool, which very few people are. Differential Disclosure. A good test of whether you can trust the management in the company is comparing what is written in documents like the annual and quarterly reports to what they have written in documents like the 10K and 10Qs. Why would there be a difference? The annual reports and quarterly reports are intended for shareholders, future and current. They're often created by a team of marketeers. In other words, companies treat it as a sales pitch. Whereas the 10Ks and 10Qs are official reports for the Securities Exchange Commission. So while a declining company can predict a rosy future in their annual report, they can't do so in the 10Ks and 10Qs as they have to follow stricter guidelines. Annual reports are still worth reading as it's where the CEO can talk about strategy. The study of both these documents will ensure management is trustworthy. Should you find large discrepancies, this should be a loud, glaring warning signal. 3. Non-operating and non-recurring items. Why do we want a company's profits to be predominantly from its operations? When longer-term investors look for a company, we're looking for a company that has staying power, that will be around for a long time, and a company that will compound our money. As such, we want companies' core operations to be successful and growing. A lot of people will glance down to the net income, which tells you roughly how much is left of a company's revenues after all the expenses and costs are deducted. It's a useful term, but it won't always give you the full picture of how a company's business has done that year, and that's because it can be influenced by things like the non-operating and non-recurring items or unusual charges. And some accountants debate what is and isn't an unusual charge, complicating the situation further. The book gives the example of Pepsi, which one year reported an unusual charge, a reduction in a previous year's valuation of bottling assets overseas, also known as a write-down. This can happen on a somewhat regular basis, so accountants would argue it's not extraordinary. However, this charge has made the earnings go down by 0.84 per share in 1982. So that's from $3.24 to $2.40. The next year, the earnings were $3.01. If you were to look at the earnings in a quick fashion, you'd think, great, the earnings have gone up by a decent margin. But in reality, the operational earnings have gone down. And this can work the opposite way too, using non-recurring items to bump up earnings for that particular year. 4. A method for predicting downward earnings? What if you could predict a slump in earnings before they occur? That would surely influence your decision to sell or invest in a company. Oglove was able to do this a few times in his regular report, Quality of Earnings, using inventory and accounts receivable. Inventory and accounts receivable are both found on the balance sheet, which records the assets, liabilities, and equity. Things to look out for are a larger accounts receivable than is normal or a bloated inventory. So first, accounts receivable. This money is due from customers when goods have been shipped out or services performed. This is pretty standard, but the problem comes when they start to rise over and above what is usual in previous years. There's been a few reasons for this. Maybe there's been a recession and there's less liquidity available than is usual. But it may be because the company could be shifting the inventory from hard sell sales campaigns. In other words, the company is having trouble shifting the product or service. A ratio can be used called the day sales in accounts receivable. This will indicate the receivable turnover, which can show you that the company is using more liberal credit terms and or is having difficulty in obtaining payment from customers. Either of which could be a negative sign for the product or service our firm is selling. So we calculate the ratio like this: accounts receivable divided by total credit sales and then times the number of days. Under 45 is considered good. So what about inventory? Higher inventory can lead to markdowns and write-offs, meaning the company is struggling to get rid of its products, not a good sign. If this is the case, it could be a good indicator of a slowdown in future production. Again, we want our company to grow, so this is a warning sign. So what we're looking for in this case is the finished goods inventory. If this segment of inventory is rising more rapidly than the raw materials, then it's likely the company will have to slow down production. However, if the reverse is the case, that the raw materials are higher, this could be a good sign for future earnings. 5. Declining and increasing expenses. Companies can use variations in expenses to influence the bottom line, making it seem like there's been more growth in earnings, when in reality there's been less, none, or even negative. Shareholders then place a higher value on the company because of these short-term changes to accounting, but may be in a shock further down the line if earnings continue to slump, as creative accountancy can only work for so long. Interest rates, production changes resulting in reduction of labour costs, changes in the price of raw materials, currency, and changes in the tax rate could have an impact on companies' earnings. Using the example of IBM in 1984, IBM reported higher earnings in 1984 than the previous year by 19%, right on target for the analyst's expectations. But the figure of $10.77 wasn't quite what it seemed. O'Glove proceeds to break it down as follows, and this is all done on an earnings per share basis. The dollar was strong at the time, but IBM got a lot of its revenues from overseas. So using the previous year's currency rate to adjust earnings this year, O'Glove says IBM would have earned an additional 54 cents per share. He then goes on to look at the tax rate and finds the previous year the company put the tax rate down as 44.8%, but in 1984 it was taxed at 43.4%. He takes the difference in the percentages and multiplies it by the pre-taxed earnings, which he then divides by the shares outstanding to get 27 cents per share. There was a reduction in selling goods and administration expense. This was because in the previous year, the company had provided incentives for employees who had worked for the company for 25 years to retire. This was not repeated, so the increase in cost one year meant a decrease in the following year. If we adjust the earnings per share for this, it comes to 51 cents per share. Then we have changes IBM made to its pension plan, which results in 8 cents per share. A change in the way depreciation was accounted for. Right, so there's a few ways to account for depreciation, and some are less conservative than others. Ideally, the more conservative a method the accountant has used, the better for investors. In 1984, IBM decided to use the straight line method, a more liberal accounting approach. The depreciation expense dropped from $3.362 billion to $2.987 billion. But there was actually an increase in the amount of plant, property and equipment, from $29.187 billion to $29.432 billion. If we then divide the depreciation figure provided by the total plant, property and equipment, we can see the depreciation as a percentage of the plant, property and equipment has dropped by 1.37% from the previous year. So because of this change in the working out of depreciation, even though there was actually more plant, property and equipment, the depreciation as a percentage of it has actually dropped. So we can see the precise number by taking the 1.37% difference we got from the 2 years and multiplying it by the amount of plant, property and equipment from 1984. And that would give us around 403 million. O'Glove then works out the tax rate for the year and deducts it from the 403 million to give 228 million. So far we've been working in earnings per share. To get this figure, he simply divides it by the 228 number of shares outstanding, and that gives us 37 cents per share. So the adjusted figure after going through these calculations is $10.08 per share versus $10.77 per share that IBM declared. And although that was still growth from the previous year's earnings, it was lower at 11%. Oglov points out this indicated that profit margins on the operations was declining, despite the CEO at the time being optimistic in the annual report. And in the early 90s, IBM was in a lot of trouble. It was fortunate to be one of the companies that were able to turn it around. More than often, this is not the case. So Quality of Earnings is a great book for those who have built a good foundation of investing knowledge and want to step up their analysis of the company's financials. There are more concepts and tools within the book, as well as many more examples with differing scenarios to help you understand and be ready to implement these techniques in your own investing. A company's annual report is often assembled by marketeers who want to sell you a product. To get a true understanding, you have to be prepared to go deeper than what they're presenting to you.